Equity Mates, from our mates at Spaceship. Investing made easy.
Welcome to another episode of Equity Mates. We are back for another week. It is Monday, pumped to be here. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going?
I'm very good, Bryce. Essendon won, so I'm expecting a lot of gusto, from you this week.
Yeah.
Sydney Swans won, so it should be a good week for all of us.
Oh, mate, can't wait to get stuck
Except,
in.
Bitcoin's down, markets are down,
Bitcoin's down. Well, anyway,
it's
that's
a real, it's
lucky
a
we're not here
mixed
to
bag.
Yes, mixed bag. But we're not here to talk about Bitcoin. We are here to talk about the budget that has just been passed through last Tuesday.
Yep.
And to do that, we have our in-house chief economist, Thomas, the economist from our podcast, Comedian versus Economist. Thomas, welcome to Equity Mates.
Yeah, g'day fellas. How you going?
Very well. How are you?
Yeah, I'm great. Still high off the budget.
This is
Nice.
the Economist Christmas, isn't it?
Yeah, yeah. All our Christmases at once.
So over the next sort of 15 minutes or so, we're going to get a bit of Thomas's take on the budget and a few of the key points. So let's start at the top. Thomas, what was your take on the 2021 budget?
Yeah, I think it's a big spending budget. It's ambitious. Lot of money for a lot of different things. A big laundry list of spending measures. I've got sort of quite a bit of feedback coming through. It's a bit hard to hear myself there. Sorry. There we go. Yeah, so big spending list of measures there. A lot for infrastructure. Deloitte crunched the numbers, looking like some big spending on infrastructure, real level up on a lot of measures. A lot of it's coming out of the COVID, so still a lot of stimulatory pulse coming out of the government sector. That's set to continue. Yeah, and sort of a bit of something for everyone was sort of the key takeaway. A lot of it was sort of accused of being a little bit political. There's sort of seemed to be a lot of the problem areas for the government, so women and aged care and those sort of things. They got a fair bit of money, but on the whole, yeah, a big stimulatory budget.
So Thomas, one thing when the budget comes around is we can see a lot of the assumptions that the government are making about the economy, and that can give us some insight into how they're thinking. What were some of the assumptions that we saw in this year's budget?
Yeah, it's a strong outlook across the board through the budget. Everything's pretty healthy, and the sort of continuing theme here is the economy is recovering much more quickly than people were expecting, and that includes Treasury back in 6 months ago when they had their MyEFO forecast. The economy is doing much better on sort of every measure that matters, and yeah, coming back much more quickly out of the COVID hole. So if you look at GDP. That's assuming we're back to trend pretty much by the June quarter. So one more quarter of recovery there. But then pretty much that's just a bit of a whoops-a-daisy with COVID, and we're back on trend going forward. So everything's sort of back to normal almost, as it were, with GDP. On the back of that strong economic recovery, we've also got unemployment ticking down, heading towards under 5% over the forecast horizon. So that's a big difference from where we were just 6 months ago. We were peaking somewhere around 8%. We're now seeing that we peaked at 7% and heading much lower and at a pretty quick pace. So that's all pretty bullish, really. And I think a sub 5% unemployment rate, even before COVID, I don't think people were expecting we were heading there that quickly. So there's a bit of a shift in thinking with the government around what they're trying to achieve, and the sub 5% unemployment rate seems to be the end result of that.
Now, Thomas, you said there was a lot of spending in this year's budget, and the government are obviously looking to stimulate the economy. What are we seeing in terms of, I guess, the deficit? And does debt and deficit even matter in 2021?
Oh yeah, I don't think it does. Or this is the big shift. So on the back of that stronger economic outlook, the budget numbers improved considerably since the last time we looked at it 6 months ago. And for this financial year, 2021, We saw the deficit come down. It was projected to be somewhere around 197 billion. That's now 37 billion better at 161 billion. So that's a big improvement based on that. Yeah, that's a big improvement. That's still the biggest deficit since World War II. So it's a very stimulatory posture, but there's a big improvement. And that was on the back of a stronger than expected economy, plus an iron ore boom that's driving a revenue increase. So good economic times improve the budget. But if you look at, so for 21, 22, that's flat. The outlook for that hasn't changed. We're still looking at 100 billion. 106 billion or something like that. And then over the forecast horizon out to 23, 24, we've actually got a bigger deficit than we did 6 months ago. And so I think UBS crunched the numbers on this and saying that we've had, through the economic improvement and the improvement in the economic outlook, we've saved $100 billion in the deficit. But the government has then turned around and taken that $100 billion and cycled it straight back into spending measures. So there's an interesting sort of political choice here. They had the opportunity with this budget to start the process of budget repair, repair in inverted commas, whatever that means these days. But they had that opportunity, but decided instead to spend it and to keep pushing the economy along. And Josh Frydenberg's now joined the 4-point-something club. So this is sort of something that started with Phil Lowe at the RBA saying that he wanted to see unemployment with a 4 in front of it. Wasn't going to even think about raising interest rates until that happened. Josh Frydenberg's now saying that he's had that epiphany too. He previously was going to think about budget repair once it was the unemployment rate was comfortably under 6. He's now saying he wants it somewhere in the 4s as well. And so that's a big shift in sort of the political philosophy, and is something that you wouldn't normally have expected out of a coalition government. But it does pave the way over the next couple of years for frees up a lot of spending to go into infrastructure projects, but also into pet projects. So we may see a bit of pork barreling come out of this as well.
Interesting, the 4-point-something club. Keep an eye on that one. So something that we're all looking for is obviously wage growth. And did the government have anything to say on the outlook for wages over the next coming years?
Yeah, this one was interesting. Not as yet. So even though the unemployment rate's quickly heading below 5%, we're not seeing any wage pressures. And if you look at sort of their assumptions there, the wage price index isn't outpacing inflation for most of the forecast outlook, which means that real wages are flat to falling over the forecast horizon. So this will be a really interesting one to watch, whether this materializes or not. You would normally think, we are starting to hear some talk of wage pressures in the system. We are starting to wonder, with that strong, with the unemployment rate and the labour market continuing to tighten, with immigration a lot lower than what it has been previously, that all might translate into wages pressure. Right now, we're not seeing it in the data and we're not seeing it in the forecast outlook yet, but there is some scope for that to materialise in the near future. And I would be expecting that. So I wouldn't be surprised if maybe those projections end up being beaten by reality.
Now, Thomas, you said it could be looked at as a bit of a political budget. We've got an election coming up later this year or early next year, depending on when it's called. What was the reaction to the 2021 budget? Was there any movement in the polls?
We didn't see anything out of the polls, actually, which was surprising. We didn't see, the polls were flat from the post-budget survey to the one before. So really, the public was a bit whatever about the budget. And I think it's an interesting one. One of Labor's responses was to call for a National Integrity Commission to seriously address some of the problems. And if you think that a lot of the problems have been sort of around sort of corruption-related themes, particularly sort of their troubles with women recently. You wonder how, if the public's going to respond to a sort of a attempt of being bought out effectively and given a whole lot of money, whereas Labor's reply is, let's look at the problems with something more serious like a National Integrity Commission, something like a federal ICAC. But so far not a lot of bounce, but maybe could have been a lot worse. Things were on the slide for the government going into the budget, so maybe this marks a turning point.
So Thomas, we have a question here that's come in from Equity Mate's audience for you, and that is around the response from Labor in terms of their budget reply. Do you have any sort of thoughts on that? Were there any major differences? Do you have a preference for which one you'd go with?
I think it was a politically savvy budget reply in the sense that it didn't seek to do too much. It didn't seek to propose an entire alternative government spending package. Labor just sought to eke out a couple of key points of difference to put in voters' minds, and then kind of just walk away and leave it at that. So I think in terms of like comparing the budgets, you can't really make that call because Labor hasn't given us the full package. But those key points of difference that they're seeking to highlight were interesting. So the key one for my mind is the support for social housing. So they've allocating $10 billion. They're going to give that to the Future Fund and then ask the Future Fund to use the proceeds from investing that $10 billion to fund social housing, with a key focus on essential workers, so nurses and police and firefighters and so on. And that's an interesting measure. They're expecting to add 30,000 homes over 5 years, so 6,000 homes a year. So that's sort of decent. That would improve the normal flow of new housing by about 10 to 12%. So it's not massive. It's not going to solve the housing affordability crisis, but it is a step in the right direction, and it's been widely applauded by people in the housing sector. So I think that sort of marks out a key point of difference for Labor. I think that's quite a smart thing to do for them. And I said that as the National Integrity Commission, I think sort of continuing to campaign on that highlights the sort of the fundamental natures of the problems and blocks the government from spending its way out of problems.
Yeah, right.
So, Thomas, that's a brief but interesting look at the budget for 2021. A lot of spending, but some, I guess, positive assumptions that the government have around the economic recovery and the unemployment rate dropping. So, look, we could keep talking budget, but we only have you for 15 minutes and would be remiss if we didn't talk to you about inflation. It seems to be the buzzword of 2021 in financial markets. We saw out of the US recently some big inflation numbers, 4.2% for the 12 months to April 2021. If we look at Australia, are we seeing a similar inflation story play out here? What's the word from our in-house economists?
Yeah, so far we're not seeing it. So unlike the US where they get inflation data on a monthly basis, in Australia we get it on a quarterly basis. So we're only up to the March quarter, so includes January, February, March. And we just got the release of that a couple of weeks ago, and that undershot expectations. So most economists were expecting a bit of a pickup, but what we got there was 1.1% on the trim mean. So this is not the headline number. This is sort of a bit closer to what the RBA is watching, sort of pulls out some of the noisy numbers. And 1.1% was well under expectations. And you see there the target band in blue, that's sort of 2 to 3%. That's the RBA's target band. And they're now saying that they're not even going to think about raising interest rates until we get inflation actually back into that 2 to 3% band. That's new since COVID. Previously, they would sort of look at raising rates on forecast inflation getting back into the target band. Now they're saying they're going to wait until they see actual inflation in the target band. And you can see from that, we're still a long way short of that. So very unlikely we're going to see the RBA move on the back of that. The thing to note, though, with that is because we're talking about the March quarter, so January, February, March, a lot of the price pressures that made their way into the US numbers, we just might not be seeing them yet. And we are hearing a lot of anecdata around rising price pressures. Freight rates, for example, are through the roof. Commodity prices are up as well. So, yeah, we are expecting to see inflation start to pick up, but we're not seeing it in the Australian data just yet.
And so some of the inflation numbers that we're seeing in the US, where is that being driven from? Is it COVID related? Do you have any sort of data on that?
Yeah, used cars apparently. Used car prices are through the roof, and a lot of that's driving the inflation. There's an interesting chart which sort of says a lot of it is COVID related. So as the economy starts to open up, we're seeing prices pick up in transport related sectors. We're seeing it in hospitality and airline prices, insurance, lodgings, hotels away from home, this sort of thing. So you can see that in the April data there. So that's sort of a big pickup. And so a lot of that is a COVID reopening story. So it would be very interesting to see how much of that is sustained and whether that's going to remain in the outlook going forward. You would think that the Fed would be looking at this and saying, like, this looks pretty transitory. It looks like a rebound out of the COVID hole. We're not going to pull the trigger just yet. It is interesting that markets have reacted much more strongly than I would expect on the back of that. Like, that looks like a fairly transitory story to me. Markets now seem to be pricing that in, seem to be pricing in rate hikes in response to an increasing inflation outlook. We're seeing a sell-off in risk assets in the US. That's interesting, I think. Maybe to my mind seems a little overdone, but we did have a big run up, out of COVID. So maybe there's sort of a rebalancing of the risks going on.
Well, Thomas, always plenty to consider when it comes to macroeconomics, but we have run out of time, unfortunately. So thank you, as always, for your time this afternoon and for sharing your expertise in this space, because it obviously makes a lot of difference when thinking about the investments that you're trying to make. So a big thank you from Alec and I here at Equity Mates.
No, thanks, guys. Thanks for having me.
So that brings us to the end of another episode. Hopefully, Thomas was able to provide a bit of value that will help you on your investing journey. If you would like more information, head to our website, equitymates.com/CVE, and you can find much more of the content that Thomas and his brother Adam are doing over on Comedian v Economist. But Ren, otherwise, we've got a big week coming up, as usual.
Got a big week. We're going to be talking to some experts. We're going to be talking about some of our favourite companies. So join us, same time, same place for the rest of this week.
See you then.
Equity Mates, from our mates at Spaceship. Investing made easy.